Hello and welcome back to session 2 of our Group Accounting Basics course. We're going to work through a more detailed statement of financial position for a group. We're going to add to what we saw before, and we're going to create some new workings that we're going to use throughout the rest of the course. Now, the first working that we used, we've already seen, the group structure, working 1. We need to outline the dates in order to see what amount of time we've had the subsidiary for. We need to outline the amount paid because that will affect the goodwill calculation, which we'll see shortly. And we need the percentages to know how to split the subsidiary's profit between the parent and the non-controlling interest. So we can do that fairly easily. What about the next working then? The equity table. So this is the net assets in the subsidiary because we need to know what we've bought. The net assets are the share capital and the accumulated profits, i.e. the equity, because assets less liabilities equals equity, but it also equals net assets. So this is the best way to get our net assets, and we're going to use this in our goodwill working and to work out our post-acquisition profit. So how do we start? Well, we go to the question and we see the statement of financial position for the subsidiary, and we pick up their share capital and accumulated profit or retained earnings at the year end. So start with that. Then we move to the acquisition date. Now the share capital will always stay the same. So that'll be the same figure. So that's easy. But if we acquired the subsidiary some time ago, they'll have to tell you what the retained earnings or accumulated profits were at that time. If we acquired them today, well then it will just be today's figure that we had at the year end. They will be the same. However, if we acquired them a period of time before that, there's going to be a movement between the acquisition date and the year end date, and that movement will be post-acquisition profit. Of course it will, because if retained earnings or accumulated profits has gone up since we acquired the subsidiary, well then that will be post-acquisition profit. We also need this figure down here, the total at the acquisition date, in our goodwill working, which we will come to shortly. As per usual, the best way to do this is to do it through an example, and we're going to do it with illustration 2 of the course, which is here, and we have a pro forma for that, which is here. So what I want you to do is see if you can complete the 2 workings that we've talked about to date, that is the group structure and the equity table. Do it in the way that I said, start at the year end, work your way backwards. So pause the video now, give it a go, and then I'll show you how to do it. Okay, hopefully you've had a go. So let's pick out the dates first. Year end, 31st of December X5. We acquired them on the same date. So that's going to make things a bit simpler. So 31st of December X5 and 31st of December X5. That means the year end date is the date of acquisition. So the figures will be the same in our equity table. And we bought 160 out of the 200 shares. That is 80%. And the NCI therefore is 20%. They don't tell us in the notes how much we paid, but we can look up here and see that the investment in DEC was 350. Okay, moving on to the equity table then. I said start at the year end. Remember, it's for the subsidiary. So the year end figures for share capital and retained earnings are 200 and 100. The share capital will always stay the same, no matter what question you're doing. And remember, in this question, the year end is the acquisition date. So actually, there's no change in the figures there. So that means we have 300 and 300. And it also means we've got 0 movement, i.e. 0 post-acquisition profit. Now, the reason that we're noting all of these is to help us with the rest of our workings, because the next working we need is our goodwill. So goodwill is the difference between what is paid or what the business is worth and the value of the assets. We generally pay more than the assets are worth to reflect their brand name or customer lists, those sorts of things. We determine that as being goodwill. So where do we get it? Well, it's pretty easy because we already noted the cost of the parent's investment in working one. The fair value of the NCI will generally be given to us in the question, so we can just check it and fill it in. Those two together is the value of the business. 80% for the parent, 20% for the NCI, less what the business assets are worth. And we got that from working to column 1, net assets at acquisition. Subtract that out and we get our goodwill. Okay, so these two figures here are what we paid for the 80% and what the other 20% is worth. So that's what you'd have to pay for the business. And this figure here is what its net assets are worth. Difference between what you need to pay and what the net assets are worth is goodwill. Okay, so again, pretty easy. Pause the video now and see if you can find those figures in order to calculate the goodwill, and then I will show you how to do it. Okay, let's have a look at this then. So I said that these figures are going to come from working one, which is, remember, up here we noted how much the parent paid. The fair value of the NCI, well, that is generally given to us, although later in the course we'll see how to work that out. So it's in there at 50. Okay, and then the net assets at acquisition are going to come from working to column 1. So that's the one we had here. So that is 300. So that is there. And actually, let's make that a minus because we need to subtract that out. And that means we've got a total of 100 for goodwill. Okay, so cost of investment 350, NCI 50, so total business is worth 400, but the net assets are only worth 300, therefore we've got goodwill of 100. Okay, what about the next working then? Well, we know the NCI has to be valued because we need to show the bit of the business that we don't own. Okay, so the bit of the ownership not held by the parent. It goes in equity because that shows ownership. There's two ways to measure it. In this one, we're looking at fair value. I'm going to go into detail on those two different methods later on. So I'm not going to bother too much with that now. We start with the fair value of the NCI at acquisition, and then we give them any post-acquisition profit. However, in this question, there isn't any. So it's really just going to be the NCI at acquisition, and you get that from working 3, i.e. we already used it. Because look, here in working 3, we already put in the NCI at the date of acquisition. So you use that figure from working 3 to start working 4. If there's been any post-acquisition profit, you bring that in as well, but there hasn't been in this one. So I'll give you 30 seconds. See if you can fill in your working for the NCI. Okay, this one's really easy. We just go, okay, equals the NCI at the acquisition date from our goodwill working. There is 0 movement up here, which means that the NCI at the year end is 50. We just add those together. Okay, now again, of course, it will get more complicated later on, but the first step is to learn these workings. Okay, the last working we need to be able to do is the group retained earnings. So we start with the parent's accumulated profit or retained earnings. We can get that from the statement of financial position in the question. And then we give the parent their percentage of the post-acquisition profit, which we work out in working 2. But of course, in this one, remember, we don't have any. So it's literally going to be the parent's accumulated profit. Let's just do that one together. that's pretty easy. We go to the statement of financial position. There is the accumulated profit for the parent, which is ANT, which is 250. There is no post-acquisition profit, so that means we've got 250 for the group. So those are the workings that we'll need to do for all of our statement of financial positions in the future. The last bit of this then is to bring it all into the statement of financial position. So the goodwill comes from working 3, the parent's share capital only, and the accumulated profit and non-controlling interest come from the workings 4 and 5. See if you can finish off this statement of financial position by bringing in all the numbers from the workings, adding across the assets and the liabilities, and then adding it up to make sure it works. Okay, pause the video now, do that, and then I'll finalize it with you in a moment. Right, let's finish this off together then. So working 3, so I'll just link that into the goodwill there. The assets I will add across, and we've only got these ones. The share capital is the parent only, which is 100. Working 5 for the retained earnings, I'll just link to the 250. And working 4 for the non-controlling interest is that one. Add across the liabilities, which are these ones. And there we go. We've got 1100 above, and let's just check that one just to make sure that when we add that up, we've got 1100. Okay, so again, this is a step up in complexity from what we did in our first session, but this is what we then need to build on for the rest of our sessions. So what you need to do is you need to learn those 5 workings. I know I've given you them in the pro forma, and I will continue to do that, but in the exam, you will need to learn them. You will need to be able to set them out. But as long as you can do that, it's actually pretty straightforward to pull it all together. Okay, see you in the next session.